Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Ken Van Leeuwen, founder and managing director at Van Leeuwen and Company, to discuss estate planning opportunities. Ken, it's great to see you again. Welcome back to Trade Talks.
Well, good to see you, Jill. Happy Monday.
Yes, happy Monday, but it's great weather in the Northeast, so we'll take that. Tell us about the lifetime estate tax exemption that is set to expire on December 31st, 2025.
Sure. Well, currently, Jill, it is currently $11,700,000 per person. But then on January 1st of 2026, and this is without any legislation as the Biden administration may be proposing, the amount is going to be dropping to $5,850,000 per person, or $11,700,000 that a couple can pass free of federal estate tax. So the challenge in that, right, is that regardless of what this tax package that they're talking about right now on the Hill is going to happen, the estate tax law is changing on January of 2026, regardless of what they come up with.
And that's going to happen quickly, believe it or not. So explain to us, what are some of the potential issues associated with that?
Well, first of all, the big deal is, of course, now some folks are going to be more susceptible to federal estate tax. So just with the law change, you're looking basically at $11 million change, or roughly about $5.5 million more in potential tax than people, or rather estates, would have to pay, which is a very big deal for many people. Also, one of the things that they're talking a little bit about, which is a really important thing, is what they call the step up in basis change. And the step up in basis is just a thing where all of us, when we pass or when we inherit money, we get the cost basis at the date of the person's death, not what they paid for their asset. So it really helps inheritors pay less capital gains tax.
So where are the estate planning opportunities then?
Well, what's really important, and this is where financial planning and estate planning go hand in hand, because one of the common things that people can do to help lessen their estate tax potential liability is, of course, making gifts. We are able to make gifts to children, grandchildren, up to $15,000 per year without incurring any kind of estate tax or gift tax. Of course, we can give more, but then when you open ourselves up to potential gift tax. So gifting is one. But again, you have to know that you can afford to gift, right? Because certain people, they live certain lifestyles. We know how much money do they need to keep. So they really can't start to give a lot of money away because they may need it for themselves. That's why you really need to create your financial plan before you do your estate plan. Another way is charitable. You know, many people are charitable, and they like to give donations, whether to their universities or religious organization or healthcare organizations. But again, how much can you afford to gift is really the important thing.
So who's involved in this process, and what's included in the taxable estate?
Well, there are many things includable in the taxable estate, right? It's money in bank accounts, it's a stock portfolio, it's real estate, it's life insurance, it may be annuities, it's business interests, it's investment real estate, it's your second home, your third home, really. So what you do is when they pass away, your executor basically totals all your assets, on a balance sheet, on a piece of paper, and that is what potentially can be subject to the tax. So again, you have to be very mindful of how can you take some of your assets out of your estate, as we call them. There are different estate planning techniques. You would want to work with a financial planner and an estate attorney to make sure you would do all the good and legal things that are available to folks right now to do that.
And to wrap up here, let's talk about beneficiaries and distribution. What are some best practices?
Well, it's always important to make sure that when you're looking at your IRAs, your 401ks, any type of retirement plan that you have, you look at your beneficiaries. So you want to know who they are. In a lot of cases, people name their spouse. You don't have to name your spouse, but you name your spouse. But if you don't want to name your spouse, actually your spouse has to agree to not being named. So that's a good thing if you name your spouse, because then that money passes to your spouse or partner, domestic partner, tax-free, and then they follow all the same IRA rules. But if you now at the second death, you name your children, that's where there was a big law change that we have to remember at the end of 2019, because now heirs can no longer stretch those retirement options out for their lifetime, which they probably previously could. Now they have to have it distributed out to themselves before 10 years is up. So it's a big thing, is that the IRS now and the federal government are looking to get their money and getting their money sooner. And that's regardless, Jill, of a tax law change that they're talking about under what's happening with, for Biden right now.
Interesting. So it sounds like there's support across both aisles for this.
It was definitely unilateral on the beneficiary change for sure when that happened in 2019. That was for sure. And of course the law, and that was part of the Trump tax cuts, right? That this estate tax was what they call sunsetting at the end of December of 2025. So that was in the current tax law. So again, these were in that big tax cut change. So now we just have to make sure, and now there's potential even that the Democrats are talking about even lowering the amount of those exemptions. So again, it's going to be a little bit of a fight, but we know already what's happening on January 1st of 26. So it's going to be a little bit of a give and take on this whole thing.
Less than 4 years, just about 4 years away. Ken, great to see you as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you, Jill.